Have you ever stopped to think about who really pays for a tax? When the government levies a tax, who actually ends up footing the bill? It seems like it should be a simple question, right? But the answer? Well, it's one of the most surprising and important ideas in all of economics. Let's get into it. Okay, let's start with a classic example. Imagine the government slaps a 10-cent tax on every liter of gasoline, and the law says the gas station has to be the one to pay it. So who's actually on the hook? Is it the station? Is it you, the driver? Or is it somehow both? This is the exact puzzle we're going to solve. I like to think of this whole thing as the tax shell game. The government places the tax under one shell, makes the business pay it, but through the magic of the market, by the time the deal is done, that burden has secretly shifted to someone else entirely. So how does that happen? Now, our first instinct, our common sense, tells us something really simple. The person or the company that is legally required to cut the check to the government, well, they're the one paying the tax. Obvious, right? But here's the thing, and it's a big one. In economics, the obvious answer is almost never the whole story. See, the law is one thing, but the market is a powerful force of its own. The real story of who gets poorer because of a tax is way more interesting than just looking at who writes the check. So, to really crack this puzzle, we have to get a couple of key ideas straight. We need to separate the legal burden of a tax from the economic burden. This difference is everything. Economists have a name for this. It's statutory incidence versus economic incidence. First up is statutory incidence. This is the easy one. It's just the legal stuff. It answers the question, who does the law say is responsible for sending the tax money to the government? In our gas example, the law points to the gas station. They write the check. Simple as that. But here is where it gets really fascinating. Economic incidence. This one ignores all the paperwork and asks a much deeper question. Who is actually poorer at the end of the day because this tax exists? Whose wallet really got lighter? This is the one that truly matters. So let's just put them side by side. Statutory incidence is all about the legal paperwork. Who writes the check? Economic incidence is about the real financial pain. Who's actually out of pocket? And the most important thing to get is this: these two are very, very often not the same people. All right, let's jump back to our gas station. So before the tax, let's say gas is $1 a liter. Then, bam, the government puts that 10-cent tax on the station. So what happens? Well, in one possible world, scenario 1, the station just raises the price at the pump to $1.10. But in another world, scenario 2, maybe they can only raise it to $1.05. Now, look at what just happened. In that first case, you, the buyer, paid the entire 10-cent tax through a higher price. But in the second case, the burden got split. You paid 5 cents and the gas station had to eat the other 5 cents. So what gives? Why are these outcomes so different? And that brings us to the big question, doesn't it? What is it that decides who bears the burden? It's not random. It's not a choice the gas station just makes on a whim. There's a powerful, predictable economic principle at work here. The answer, the secret ingredient, is a concept called elasticity. Now, I know that sounds like a super technical term, but don't let it scare you. At its core, it's just a way of measuring flexibility. And that flexibility is what determines everything. Honestly, the best way to think about elasticity is to just call it your ability to walk away. That's it. If the price of something you buy goes up, how easily can you switch to something else, or just decide not to buy it? That's your flexibility. That's your elasticity. So let's break that down. If your demand for something is inelastic, you have very low flexibility. Think about essential medicine or the gasoline you need to get to work. You don't have many alternatives. You can't easily walk away. But if your demand is elastic, you've got tons of flexibility. Think of a specific brand of soda. If the price goes up, you can easily walk away and buy a different one. And this all leads us to the golden rule of tax incidence. It's this simple. The side of the market, whether it's the buyers or the sellers, that is less flexible, the one that can't easily walk away, that's the side that gets stuck paying a bigger share of the tax. They're basically trapped, so they end up paying. Okay, so far we've just been looking at a single market, the market for gasoline. But here's the thing. A tax is like a rock tossed into a pond. The ripples don't just stay in one spot. They spread out, and they can end up in places you'd never expect. That's because no market really exists in a vacuum, right? Everything is connected. The price of lumber affects the housing market. The cost of a restaurant meal affects the wages of its cooks and servers. So let's trace the path of a tax through this giant interconnected web. Let's trace that ripple. Say the government puts a tax on restaurant meals. Okay, step 1, that makes eating out more expensive, so fewer people go out to eat. That's step 2. Now, because business is slower, the restaurant doesn't need as many workers or as much equipment. That's step 3. And all of this leads to the final step. The burden actually lands on the workers through lower wages or fewer hours, and on the owners through lower profits. So think about that for a second. The tax that was legally placed on the customer's bill, it didn't stay there. It filtered all the way down to the people and the capital that make the restaurant run in the first place. The tax didn't stay put. And this brings us right back to the single most important lesson from all of this. It's a phrase worth memorizing, really. Statutory incidence does not determine economic incidence. Who the law says pays the tax, that tells you almost nothing about who actually ends up paying it. The best way to think about it is like this. Deciding who to legally tax, that's a political choice. But the final result, who actually ends up poorer, that's an economic reality. And it's dictated by the powerful, unchangeable forces of the market, especially elasticity. So, the next time you hear a debate about, say, taxing big corporations or taxing the wealthy, remember what we've talked about. The real question isn't just who do we want to tax? The much more important and much more difficult question is who, at the end of the day, has the least flexibility, and therefore, who is it that truly can't escape the tax?